When you invest in a company, have you ever stopped to wonder if you're really getting your fair slice of the pie? Well, there's actually a single number that helps you figure that out. It's called earnings per share, or EPS. In this explainer, we're going to break down exactly what that means, how you calculate it, and most importantly, what it really tells you about a company's financial health. So let's dive right in.
You know, when you buy a stock, you're not just buying a little ticker symbol on a screen. You're actually buying a tiny piece of a real company. And that makes you a part owner, which means you're entitled to a slice of that company's profit pie. So the big question is always, how big is your slice, and is it a fair share?
And that, right there, is where earnings per share comes into play. It's such a powerful metric because it tells you exactly how much of a company's profit belongs to your single share of stock. You can think of it as the ultimate measure of profitability, all from your perspective as an owner.
To put it as simply as possible, EPS answers one question. If a company took all of its profits and handed them out to the owners, how much money would each individual share get? It's a really powerful number because it boils down all that complex performance into one single, easy-to-digest figure.
Okay, I know what you might be thinking. Formulas can look a little intimidating, but I promise you this one is super logical once you see all the moving parts. We're just going to build it together, piece by piece, and it'll make perfect sense.
So the starting point for our formula is something called net income. The easiest way to think about this is that it's the company's take-home pay. It's the total profit that's left over after every single expense has been paid. We're talking salaries, rent, materials, taxes, everything. This is the total pie that we have to work with.
But wait, hold on. Before we, the common shareholders, can get our slice, the company has to pay a special group of investors first. These are called preferred shareholders. They're often early investors who get priority, and they get a fixed payment. So we have to subtract these preferred dividends right off the top, because that money is already spoken for. It's not available to us.
And finally, the last piece of the puzzle, shares outstanding. This is just a fancy way of saying the total number of a company's shares that are out there in the world held by investors just like you and me. Basically, it tells us how many slices we need to cut that profit pie into.
And there you have it. That's the whole formula. We take the profit that's actually available to us common shareholders, which is the net income minus those preferred dividends, and then we just divide it by the total number of shares. See? Not so scary when you break it down like that.
All right, so theory is one thing, but let's see how this actually works in the real world with a quick example. We're going to compare two imaginary tech companies, and I think you're going to be surprised by what EPS shows us. This is a perfect illustration of why just looking at the big profit number can be really misleading.
Okay, here's our setup. Now, just looking at this, at first glance, Company B seems like the clear winner, right? It's got a much higher net income, a whopping $8 million, compared to Company A's $5 million. But look closely. It also has double the number of shares out there. Let's do the math and see what happens.
So let's start with Company A. We'll take its $5 million in net income, subtract that $200,000 for preferred dividends, and then we divide all that by its 1 million shares. And that gives us an EPS of $4.80. Okay, pretty solid.
Now let's look at our supposed champion, Company B. We take its massive $8 million in net income, subtract the $300,000, and then divide it by that huge number of shares, 2 million of them. And what do we get? Whoa, only $3.85 per share. And this, right here, is the key insight. Even though Company B makes more money overall, Company A is actually way more efficient at generating profit for each and every individual share. It tells us that on a per-share basis, Company A might just be the more valuable investment.
Now, before you run off and start making investment decisions based only on EPS, there's a really important catch. EPS is just one piece of the puzzle. A smart investor is also going to look at things like, is revenue growing? How much debt does the company have? What does its cash flow look like? You've got to see the whole picture.
So, we've figured out how to calculate EPS, but that number isn't set in stone. It can and does change all the time. To really understand why, I want to use a simple and kind of delicious analogy, a birthday cake. When it comes down to it, there are really only two main ways a company's EPS can change. The first one is pretty obvious. The company just earns more or less profit, right? More profit means a bigger cake. But the second way is a little more interesting. It's by changing the number of shares. In other words, changing how many slices we cut that cake into.
Okay, so imagine the company's total profit is your birthday cake. Now, let's say the company decides to issue new shares to raise some money. That's like a bunch of new guests showing up to your party unannounced. You've still got the same size cake, but now
You have to cut it into much smaller slices so everyone gets something. This is called share dilution, and it makes your slice, your EPS, get smaller.
Now let's look at the flip side. What if the company uses its cash to buy back its own shares from the market? Well, in our analogy, that's like some of the guests at your party deciding to leave early. Suddenly, you can take that same cake and cut it into fewer, but much bigger slices. This is called a share buyback, and it's a really common way for companies to boost their EPS and give every remaining shareholder a bigger piece of the pie.
All right, so we've defined EPS, we've taken apart the formula, we've seen a real-world example, and we know why it changes. Now let's just zoom out for a second and talk about the bigger picture, how to use this powerful metric wisely. The real beauty of EPS is its simplicity. It's easy to find, it's pretty easy to understand, and it gives you this really clear snapshot of how profitable a company is for each share. It's especially useful for making those apples-to-apples comparisons between direct competitors.
But, and this is a big but, it is not perfect. You have to know the downsides. EPS can be played with through different accounting tricks. It tells you absolutely nothing about a company's debt or its future growth potential. And as we saw, things like share buybacks can make it look good even if the company isn't actually earning any more money. It's a tool, not a crystal ball.
And finally, it's so important to remember that EPS is almost never used all by itself. It's actually a foundational building block for one of the most famous valuation metrics out there, the price-to-earnings, or PE ratio. That ratio takes the stock's price and compares it to its earnings per share, which helps you get a sense of whether a stock is overvalued or undervalued.
So at the end of the day, the biggest takeaway here is that EPS is a fantastic starting point. It's a vital clue in the detective work that is investing. It tells you a really important part of a company's story, but it should always leave you asking, okay, but what's the rest of the story? Thanks for tuning in.